Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to customer payment terms and discount policy. Get ready, it's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. Notice that we have two tabs down below. If you're following along in an Excel worksheet with us, you may have 4 tabs, 2 tabs with the answers to it, 2 tabs with our practice problems. If we go on over to the second tab, we'll have a similar problem. It'll have a bit of a different layout. The second problem we will be looking at will have our discount that will be involved. First problem will not. That will be our difference. Going back to the first problem here, we have the credit sales at the $680,000. The payment terms are 60 days. The average collection period then being the 60 days. We're going to say that customers pay as late as possible. And that's typically our what will happen oftentimes, especially if you're in a business-to-business type of situation. If you're selling to other businesses and they're trying to maximize their cash management, as we've talked about prior to this, then they will try to hold on to their cash as long as possible and pay as late as possible. If you have 50 or 60-day terms on what you're selling to a business, they will try to wait 60 days and then pay you at the end of the term. And that's what generally will happen. Now, we could shorten that up. We could try to change the terms, and we could try to give a discount. So that's some of the options that we might have in order to improve our cash collection, because of course on our side of things, we would like to have our credit sales be received as soon as possible. So let's start off with the 60-day term. That's a long term. Possibly we might be able to get it down to 30 days, right? But if we had a 60-day term, then we would expect, if we have a business-to-business kind of situation, with another business that's trying to maximize their cash management, we're going to expect that we get paid at the end of that term, which is going to be 60 days, and then think about what we can do to adjust that. So let's start here. We're going to calculate then our average receivable balance. We'll calculate then our accounts receivable turnover amount here. Now, there's a couple different ways we can think about the average receivable balance. When we think about the receivables, we're thinking about a balance sheet account. So we're trying to project out into the future what our balance sheet kind of average balance would be, given what we're estimating our credit sales to be and our payment terms. Where the balance sheet accounts receivable account is a financial statement number. So in this calculation here, the average collection period is what we would typically calculate on the financial statements if we weren't doing a projection forward. So this number is what we might want to think about the formula for, to then use our algebra to back into the financial statement number that we're trying to project out into the future, that being accounts receivable. So that's how I would basically start. We'll do that calculation on the right, and then we'll do the calculation as if we're just calculating accounts receivable with the known data on the left, basically adjusting the algebra to do that. So if we have the accounts receivable, we're going to say we're looking for the accounts receivable related to basically these credit sales that we're going to basically have. We're going to say then that's the unknown. I'm going to make that yellow. So that's the unknown. We're going to divide that by the average daily sales, and I'm going to do a subcalculation to pick up the average daily sales. So I'm going to say average daily sales, colon, and that's going to be the credit sales, which is going to be this item over here, and that's going to be the 680. And then we have the days in a year. Days in a year, which could be 365, or if we try to simplify the months as 30 days in each month, would be equal to 12 months times 30 days, or 360. Let's put the underline there, go into the Home tab, Font Group, and Underline. And then we're going to say that this is an average daily sales. We'll put this in the outer column now, that being equal to the 680 divided by 360, for the 1,889. And now we can think about what our average collection period is. Average collection period. Now this was given to us. This is what we have. So we're going to say this is going to be equal to the 60 over here. And we're going to underline. Let's put an underline. Home tab, Font Group, Underline. So then we can do the algebra, which would be X divided by the 1,889 would be 60. If we did that algebra, then we're going to say this needs to be equal to the 1,889 times the 60 to get the 113,333. We can double check that number by then doing our normal calculation the way we would for average collection period. The 113,333 divided by the 1,889, giving us then once again that 60. Now, if we did that calculation as if we were taking these numbers and calculating the accounts receivable, just basically doing the algebra to put in the information such that we will get the average accounts receivable at the bottom of our calculation. We would then take the average collection period. So the average collection period, because we're saying that everybody's going to be paying at the end of that 60 days, we're assuming. And then we have the average daily sales, colon, subtotal credit sales is going to be equal to, I'm putting this in the inner column, this 680. Then we have the days in year, assuming even 30 days each month equals 12 times 30 to make it nice and round. Home tab, font group, underline, and that's going to give us the average daily sales in the outer column, this being equal to the 680 divided by the 360, and then we can pick up our average receivables. So let's just call it accounts receivable. And that's going to be then equal to the 60 times the 1889. So I'm going to put an underline here, home tab, font group, underline. So as we've seen many times here, this is probably how someone would present this to you if you were to ask somebody about it. But you probably want to learn it kind of knowing it this way, so that, because this is the formula that you would have memorized or think about, or this is the one you could look up. You can't really look up the accounts receivable formula, right? You can look up the average collection period formula. All right, and then we can calculate then the accounts receivable turnover. Accounts receivable turnover, credit sales, we're going to say is going to be equal to the 680. And then we have the average accounts receivable. Let's just call it accounts receivable. We'll pick up the accounts receivable. And this is going to be equal to the 113333. Let's put the underline there. Home tab, font group, and underline. And then we're going to have the accounts. Hold on. Control V, undo. And then accounts receivable turnover is going to be equal to then the 680 divided by the 113333. So that's going to be 6 for our accounts receivable turnover. Now, what if we made an adjustment to this? We could say, okay, I would like to get the money sooner because we know with our cash management, we would like to collect on it sooner. So we could have a policy. We could say, well, I'm going to go to the second tab. If I assume the same credit sales of the 680,000, what if we say, hey, if you pay within 15 days, we'll give you a discount, and that's going to be a cash discount. We'll give you a discount in order to pay us sooner. So remember, people in the cash management world are going to be saying, hey, I'm going to pay as late as possible in order to maximize my cash so I can hold on to it as long as possible. But if you give me a 3% discount, then that should shift, especially if you're business-to-business clients, should be saying now when they look at their cash management, they're going to say, I'm going to maximize the amount of time I can hold on to the cash while still taking advantage of the lowest price, which now that we offer a 3% discount will be after 15 days. So now we're going to say we want to be paid within 60 days, but if you pay us within 15 days, we'll give you a 3% discount. And we can start to consider what the effect of a discount would be. Now note, we'll go into more complexity with the effect of a discount because the discount could have other effects as well. Because obviously, one, we have to pay the amount related to the discount, so that's going to reduce the amount of cash that we're going to get by some amount. But it could also increase the sales that we have, because basically if we give a discount of 3%, even if it's due to paying cash sooner, then we're basically lowering the sales price as well. And if we lower the sales price, we may increase sales. So we can see, even though these factors are pretty easy to see in and of themselves, there can be a lot of different outcomes that we can basically think about. So let's just think about what we have here with the average receivable balance and then the accounts receivable turnover. If we were to basically have a discount of the 3%, and we're going to then assume that due to that, we're going to have people paying us within the 15 days as opposed to waiting out for the 60 days, which could increase our ability to get paid sooner, but at the expense of us having to pay the discount. So then we're going to have to balance those two things out. We'll talk more about that in future problems. And again, we could have other effects as well including possibly increasing sales. And again, we'll talk about that more in future problems. So we're going to do our same thing here. We're going to say, okay, the accounts receivable, let's do it over here. We're going to say, I want to figure out what the accounts receivable, the average accounts receivable would be. If we were to do that, I have sales here, and I know that we're going to assume that we're going to get paid within the 15 days. The assumption is that all the vendors are going to now switch their policy to pay us instead of 60 days in 15 days to maximize the price. So we're going to say, all right, let's figure out then our accounts receivable, and we're going to use then the calculation for the average collection period, because that's the term that we know, that's the formula we know, and then we'll switch that over to do the accounts receivable as if we're calculating it, adjusting the algebra for accounts receivable as we did last time. So this is the unknown. Then we don't know the accounts receivable. I'm going to make it yellow, right-clicking on it, making it yellow. And then we're going to divide that by the average daily sales, which we're going to calculate inside with a sub-calculation. It's going to be average daily sales, colon. That's going to be the credit sales. So I'm going to pick up the credit sales tab. That's going to be equal to the 680,000. We're going to divide that then by the days in a year, which we're going to round out to 30-day months, so 12 times 30. And let's put an underline under that 360, home tab, font group, and underline. And that'll give us our average daily sales. Putting that in the outer column, this being equal to the 680 divided by the 360. That's going to be the 1889. And then we have the average collection period. And that's going to be our unknown. So that's our unknown. I'm sorry, that would be our unknown, but we know it this time. It's going to be 15. And so we're going to back into the unknown, which is accounts receivable. I'm going to put an underline here, home tab, font group, and underline. So the algebra then would be x divided by 1889 equals 15. If we were to do the algebra, then it would be equal to the 1889 times 15 to give the 28333. And then I'm going to basically divide it out again just to make sure that this works. So 28333 divided by the 1889 would be 15. That would be our normal calculation for average collection period. Let's do it again as if we were just going to rework the algebra. This is how someone would probably be presenting this to you. They'd say, hey, you calculate the average receivable balance if you have this information this way, instead of telling you, well, you use the average collection period calculation to back into the algebra to the number you need, which is the financial statement account of accounts receivable, right? So this is going to be the, we're going to call it the average collection period, which we're going to say then is the given of 15. I'm going to put that in the outer column. We're going to do, once again, a calculation for the average daily sales. Average daily sales, colon, is going to be equal to the credit sales. Credit sales in the inner column, the 680. We're going to divide that by the days in a year, which we're going to round to nice even 30-day months, 12 times 30. Put an underline there by going home tab, font group, and underline. Then we're going to have the average daily sales, outer column, equals 680,000 divided by 30. 1889 to give us the average receivables. Average receivables, let's call it. And let's just call it accounts receivable balance is going to be equal to the 15 times the 28333. Let's put an underline here, home tab, font group, and underline. So you can see now we're at the 28333. If I go to the prior tab, we were at the average receivable of 113333. So we have a higher amount of an asset. Receivables is good. We like receivables, but we would rather have the cash, right? So we'd rather convert the receivable to cash sooner, which of course the discount is doing that, but at the cost, at the expense of us having to have a discount, lowering the amount of cash that we will ultimately be receiving. So we'll talk more about that later, but you can see the strategy here. And then we've got the accounts receivable turnover then would be equal to the credit sales. Credit sales at the 680,000. We're going to divide that by the accounts receivable, which is going to be equal to the 28333. Let's put an underline there. Home tab font group and underline. And then we have the accounts receivable turnover equal to the 680,000 divided by the 28333. That gives us 24 about. We can add some decimals, home tab numbers, add a couple decimals, 24 even, it looks like. Okay, that's great. So again, you can compare and contrast the first tab and the second tab and see that our receivable turnover, of course, here is going to be higher in the second scenario because we're basically, we've put in a policy that increased greatly the turnover. But again, there's cost to that. So, and the cost is going to be including the amount of the discount that we're going to be putting into place. So if we were to consider this policy, then we'd have to then do some further analysis in terms of, what's the bottom line effect. One, on the cash flow, like if we free up this cash, if we were able to basically lower the receivables, we would free up cash. And then if we did that, what's the point? I mean, are we going to get a return on that cash? Like, what can I do with that cash in order to get a return on it? And then we have to consider the effect of us, that our ability to get that return was dependent on lowering the amount of cash we're going to get by providing a discount. So we're going to have to balance that out between the cost of the discount. We'll see that in the future problem. And then we could also, like we say, have another impact, which could be the fact that if we offer a discount, we might increase our sales because basically the sales price is lower at that point, which could increase the sales amount. And that's another factor that we could put into play, which could complicate the scenario as well. So we'll see some more of that next time.